This period looks more like the 1940s to the 1970s. It's coming from the fiscal side, not from the bank lending side. I think that's kind of the closest parallel. That's what I've used for investing. Now, things aren't always the same. Harder assets over softer assets. So basically, if you bought equities, if you bought real estate, certain commodities, commodity producers, those things did well. Gold was tougher because it was pegged to currencies. What's new is that large institutions are talking about debasement and talking about the risks of sovereign debt, which would have been unthinkable a decade ago. So it's kind of the mainstreaming of concerns that many investors have had for quite a while.
Lyn Alden, engineer, financial analyst, author, and founder of Lyn Alden Investment Strategy. It's a true pleasure to host you on Palisades Gold Radio today.
Happy to be here. Thank you.
Excellent. Really excited for this chat. And I would actually love to get started talking about your gradual print thesis that you have, which seems to be quite bullish for hard and scarce assets. Of course, we have already seen a phenomenal bull run in, for example, precious metals, and gold, more specifically, is up over 60% year to date. However, might we just be in the first few innings of a secular or really long-term bull run for precious metals or scarce assets in general based on that gradual print thesis?
Yeah, good question. I mean, I think the macro conditions that fuel this type of thing are going to be going on for quite a while, many, many years. I would say we're in a state of fiscal dominance in the United States as well as many other developed countries. And so basically, we have very large structural deficits as far as the eye can see. We're probably shifting from a period of kind of monetary tightening to monetary loosening in the coming months. And individual assets can get ahead of themselves from time to time. I think that gold and silver, while attractive, are now getting somewhat, overbought in maybe the tactical sense. I don't view them as structurally overvalued. And so I think, some combination of equities, real estate, precious metals, Bitcoin, these kind of assets, they have their individual years in the sun. But I think that continues to be the kind of assets that investors want to own over the long term.
I think this fiscal dominance thesis of yours is incredibly interesting. And I think a lot of other analysts are also coming to a similar conclusion that these government debts that we're seeing around the world, not just in the United States, are unsustainable and the only way out is to print. What makes you different in a sense that you think this is going to be a gradual process rather than a sudden one?
Yeah, I mean, basically, when developed markets go through debt crises, because they have one is the debts in their own currency, and they, especially the United States, but even many other developed countries, they have external demand for their debt. And so, when a country like, say, Turkey has a debt crisis, there's very little external demand for their currency. And so when they run into a problem, you can get a very, very, very rapid period of inflation and currency debasement. But when you have a country like the United States, there's something like 18 trillion in dollar-denominated debt owed by offshore entities around the world. And that's mostly not owed to U.S. entities. That's owed to other offshore entities. It's like this big patchwork of existing kind of liabilities. And all of that represents inflexible demand for the currency. And it's a pretty large percentage of the money supply. It's much larger than the amount of base money in the system. So you have all those IOUs, plus you have other types of demand for the currency. And so basically you have this crazy amount of entrenched demand, the network effect. But then you have insolvent systems. We have a top-heavy entitlement system. We have interest expense that's now, because you have over 100% debt to GDP, with interest rates no longer structurally falling like they were for 40 years. We finally have interest expense becoming like a pretty material part of the budget, bigger than defense, which is generally not a good sign as far as what stage you are in the empire. And so you have this kind of crazy amount of structural fiscal deficits as far as the eye can see, with very few kind of realistic political levers to fix them anytime in an investable time horizon. And so I think that this is a state that's going to go on for quite a while. And it's, when people ask me things like, when does the debt matter? I would say it has mattered for 5+ years now. You can go back further and say aspects where it mattered, but especially the past 5 years, when we have kind of record stock prices, but also near record low consumer sentiment in the U.S. So the median person is finding the economy to be rather sluggish, especially at a cost of living sense, because you have that more like stagflationary type environment, so not like a clear recession, and not really rapid inflation, but some kind of combination of, kind of weak economic prospects out of AI, like outside of AI and out of, kind of the fiscal recipients, combined with price increases that are coming from those fiscal injections. It creates this mix that can go on for quite a while. Eventually, it can snap politically. There's obviously political turmoil in Europe. There's political turmoil in the U.S. But I think these states are going to go on for quite a while structurally.
Incredibly interesting. And you mentioned earlier that there's very few realistic levers one can pull. Of course, one that's often named is to outgrow this debt, like the US did after the Second World War, when it also had an incredibly high debt to GDP. Recently had Doomberg on the channel, who referenced that the United States has incredibly fast, natural gas and oil reserves that it has untapped thus far. If energy is, correlated with GDP or perhaps correlated with GDP, is there a potential for the United States to outgrow its debt?
In a sense, I mean, so after World War II, they partially outgrew the debt, but they also inflated the debt away. Anyone who held bonds from the start of the 1940s through basically the 50s, you basically lost purchasing power, especially in the 40s. So I mean, say they held interest rates at 2.5% on the long end, while you had 19% year-over-year inflation at the peak. They did outright yield curve control. Bond and currency holders pretty much got killed on a real basis. And then even after that, even when they got into the 50s, while you no longer had the rapid falling of bond purchasing power, it still would have been better to own almost everything else, especially equities at the time. And so basically harder assets. So it was that combination. They had really fast productivity growth combined with inflating the debt away. And so that's why you didn't get hyperinflation, because they did have real productive growth. But it's not as though bondholders were made whole. I think the best case scenario is something like that. Now, the issues, of course, back then, the United States had a trade surplus. They were a manufacturing powerhouse. We had very young demographics. Now we're going into this as a trade deficit nation, hollowed out industrial base, with a much more top-heavy system demographically. And so the levers are harder. Obviously, AI and technology in general is always a very strong lever to help with that, as well as energy. But it still comes with that degree of debasement. And so basically, you want to own assets that are well positioned for that environment, and generally be cautious of assets that do get debased along the way. Because if you have something like, say, on average, 7% money supply growth, and you're getting very low yields, if anything, on a checking or savings account, moderate yields on money markets and T-bills and treasuries and things like that, you're holding those assets and you're getting debased, relatively speaking, especially compared to scarce things. And so when we look at the kind of the spectrum of inflation, it's reported as one number. What is year-over-year CPI? That's how it's always presented to us. But really, it's a spectrum. There are assets that we're not really, the money supply is going up, and we're not getting much better at making these things. Things like that are either labor intensive or energy intensive or otherwise scarce. So, for example, fine art, waterfront property, gold. To some extent, things like beef. Like energy dense types of food. Um, Hospital services that are still very labor intensive and of course technology intensive. Those things tend to go up at or close to the growth of the money supply over time. Whereas things that we have gotten exponentially better at making, things like manufactured goods that we've outsourced and automated as much as possible, things like grains, kind of the less nutritious dense foods, textiles. These things have fallen rapidly in price, and they've given us a deflationary component that has offset some of those faster moving areas. And when we look forward at what energy abundance and or AI can do, there's certain things that they can make more abundant. Maybe, for example, AI can automate some white collar work in a way that automation did for blue collar work. We can get certain services can get more abundant because of that, and therefore their costs can be kept down. But truly scarce things that are either energy or labor intensive, while you have this period of pretty rapid, money supply growth that continues, they still tend to go up in price. Maybe not every single year, but when you look at a 5, a 10, a 15-year snapshot, you get that kind of widening differentiation between things on the higher end of that, kind of labor and energy spectrum, and things on the lower end that are able to be more automated and mass produced.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Gold Corp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Incredibly interesting. And you mentioned earlier this hollowed out industrial base that we've now seen in the United States. Of course, the current president is trying to turn that ship around. However, that is something that takes a while. Could both be a headwind trying to turn that ship around because you're cutting yourself up from cheap goods that might, cause inflation. However, from the other side, trying to restart this economy, this industrial economy could be a boon and cause significant growth.
Well, so I do think that it is worth trying to reshore some of this. The challenge, of course, is that the administration wants the cake and eat it too, which is natural of politicians. You want all the good stuff, but none of the cost. So one of the issues, of course, is that part of why we're hollowed out is because we have the global reserve currency. And most people don't understand how closely these are linked. It's been known since the days of Triffin and the Triffin dilemma, but it's a challenge, which is right now kind of the whole world wants and needs dollars. I mentioned before they have dollar-denominated debts, but they also use it for reserve assets. They also use it for international pricing. They use it for exchange reserves, all these different things. So there's all this extra demand for dollars, and the question is, how do they get all those dollars? There's all this, trillions of demand for dollars in the world, and the answer is we send it out to them a trillion a year in structural trade deficits. We just keep flowing dollars out there. And the mechanism for that is that because there's so much demand for the dollar, they overvalue it compared to what it would trade purely on an interest rate and kind of trade balance differential. So they have this extra monetary demand for the dollar. It boosts our import power. It hurts our export competitiveness. Now, higher margin areas like tech and healthcare and financial services, we can still export quite well. But lower margin things, that's where we pretty much get killed, and that's our manufacturing base. And so, kind of the cost of running the world's ledger and having to support all the demand for usage of that ledger is we basically outsourced our industrial base. And I do think it's time to bring some of that back. But that's actually going to come at the cost of being able to run the whole world's ledger and being able to sanction anyone and kind of do whatever you want in that sense. And so I don't think that those can be separated. And if you look at this year, I mean, manufacturing jobs in the U.S. are down slightly compared to the start of the year. So it's not even like we're slowly kind of trending in a certain direction. It's still pretty much, if you look at a chart, you can't really tell that there was any sort of reindustrialization. Manufacturing spending on new manufacturing facilities is not really it's a blip on the macro scale. Industrial production is flattish. Manufacturing PMI, so purchasing manager indices, have showed weaknesses all year. I mean, they showed weaknesses the year before too, so it's not like a new thing. And so it's not a easy issue. At best, it's a multi-year endeavor that you can start, but at worst, you fail to start it, or you kind of do optics and fail to get substance, because these are very intertwined, complex issues. So we are getting, the private market is doing a good job of building out AI data centers and trying to get the power to support all that. There is clear demand for it. They launch these AI apps, and 200 million people sign up and start using them in the U.S. and globally. Whereas manufacturing facilities are kind of a different story. And so, I think that while the kind of the diagnosis of the issue is real, and I do think that while after having been ignored in U.S. politics for decades, the trade deficit, I do think it's right to be kind of front and center The question is, how is it addressed? And I think that we're at a stage where no one really wants to pay the cost. And that's also why the fiscal deficits in the US and many other countries not going down anytime soon. Nobody wants to pay the cost of getting that down. No one actually wants to cut the programs that are popular. Nobody wants to raise taxes, where it's unpopular. You get pushback on that. And then similarly, politicians don't really want to do the cost of reshoring things. There's environmental impacts that is often they run into not in my backyard syndrome, where people say they like it in their country but not near me. So then you have this kind of fractured state of, well, where do you put these things? How do you power them? And then even if you try that, it's like, well, you're going to have an issue with the dollar system. And so I think this is a long-term trend that is usually not resolved smoothly.
Incredibly interesting, Lyn. Do you think a treasury auction that fails, that doesn't get a bid, is something that's in the cards on the short term?
Not in the short term, no. So prime dealers are pretty much required to bid, and whenever they get too full, that's where the Fed bids. The Fed can, but they can buy treasuries from them and basically refill their liquidity. So I don't really see that anytime in the kind of investable time horizon. Now you could have a technical glitch of some sort or some sort of like kind of liquidity pop, like we saw, for example, in September 2019. There was that repo spike, which by the next day they printed money and put out. So a lot of these little issues can be resolved by printing money. You get these little fires that pop up. I mean, people probably remember the 2022 UK gilt crisis. That was a little mini crisis that happened. They put it out with a little bit of money printing. And it's not, obviously the UK has issues now economically, um, and these things they keep getting put out by, you put out the immediate fire with a little bit of money printing and you kick the can down the road. And I think the U.S. is going to keep doing that. So no, I don't view a kind of a persistently failed auction as anything that's like investable.
When do you think kicking the can down the road will finally, bite the US in the United States as a proverb? When do you think it will finally become a true problem that might not be solvable anymore by kicking it further down the road?
I would say there's two answers to that. I'd say one is that there's already a problem. It already impacted. I mean, that's why like voter sentiment, consumer sentiment, both for the prior administration and the current administration are low because it's the core issues are just not being tackled. And that's why, despite the fact that stocks are up and gold is up, the median household in the U.S. is struggling. And so it already matters. We're already paying the price for these policies. But that doesn't mean it stops, right? So the second answer to the question is I think not for a very long time. Like I think earliest is 2030s. But it could go on a lot further than that. That's kind of where certain big decisions get made. For example, the Social Security Trust Fund runs out in the mid 2030s, so that'll be kind of an interesting decision point to see how they handle that, because that has various political ramifications. But between now and then, I think they will keep pushing this down, and they will keep paying the price for it. It's not a costless can kicking. Um, and a lot of people when they think of like things like failed auctions or crises, they often look at this in a vacuum. I mean, I spent part of each year in Egypt. They were dealing with, it was a couple years ago, it was 38% inflation. Um, uh, and the currency crises all over the place and issues like that. They weren't having failed bond auctions. It's like there's the U.S. Like we consider 9% inflation an absolute crisis. Many parts of the world, that's like a normal Tuesday. Um, and these systems can, often keep the wheels on the cart more than you'd think. And the U.S. has a lot of runway. But what snaps, I think, is before the numbers snap. I think the politics snap in the sense that you have these kind of rising populism, both on the left and the right, uh, increasing discontent with how things are going. No one's really, because it's a complex topic. No one talks about Triffin's dilemma when they're talking like angry about politics, and no one's talking about, when they think why the deficit's so big. People say, is it Trump's fault or Biden's fault? No one says, well, maybe we're still paying interest on the Iraq War. from decades ago, or maybe we didn't set our entitlement systems up well decades ago, and that they're basically very top heavy now because they always expected to have the next generation be larger than the current generation, and none of these systems make sense when you get a generation that's smaller than the prior generation, and people live longer. So you have these kind of structural issues that have been building for decades. And so you get these kind of rising problems. But then, yeah, whenever you do have a little mini crises, um, they can put it out for a good period of time and keep pushing it.
That almost sounds like a fourth turning type style thesis where, political discontent would just increase due to these problems that we're looking at, and that could cause a certain type of cycle.
Yeah, I mean, I've read the fourth turning. I think that's what we're in. Now, the fourth turnings, they have a quantifiable aspect to them because they've coincided with debt crises, long-term debt crises. Um,
Hmm.
and so, I mean, I think we're going through that similar environment now, except in the U.S. I mean, back when we went through the prior fourth turning, we had an external enemy to focus on. We were very unified as a country. And now there's no external enemy to blame, whether it's the U.S. trying to figure out who to blame or parts of Europe trying to figure out who to blame. The calls from inside the house is the problem. We just mismanage our ledgers. We've got demographic challenges. In some cases, more so Europe than the U.S., but there's been energy mismanagement issues. Um, and these things, the price, the bill slowly coming due. It's not that there's one, day of reckoning where it just hits all at once. It's already hitting, and the consequences are already being felt, and I think they're going to continue to be. And it is hard to say ahead of where this resolves. I mean, does it kind of swing? Does one of the populist sides eventually get kind of a decisive victory and a persistence and kind of a cultural realignment around that new approach, like we saw in the prior fourth turning? Probably eventually. I still think that's probably got a longer way to go because we still have very high signs of populism, very high signs of both trying to struggle with the existing system and trying to figure out what the next system would look like. Um, and it is, it's harsh times for kind of broadly speaking the Western world.
No, definitely. And you mentioned incredibly interesting point there, demographics for a second. Of course, if you have declining birth rates or a population that's decreasing in size due to the birth rates that you have, that only makes the mismanagement or at least the high debt to GDP that you have that much harder to handle.
Yeah, I mean, there used to be this kind of the idea that aging demographics was deflationary, but that's only generally true if you don't really have entitlement support systems. So, I mean, if you look at many years and decades ago, many elders were impoverished, and now in many Western countries, elders are not impoverished. They consume a lot of healthcare. They have support, and all of that is consumption and they're past their productive years in most cases, not all cases. Individuals differ, but they stopped working. They're still consuming, and when you have that kind of very top-heavy environment, that can actually be kind of inflationary. And I think Japan has given some people in the world a little bit too much complacency because they aged first, for them it was rather disinflationary. But there's a couple things to keep in mind. When they're first, they had the whole rest of the world that wasn't in that state yet. So they while they're still exporting kind of complex goods, I mean they were benefiting from having China as their neighbor right next door, this huge labor pool to make goods and services for them. They had all these other things going on. They had this the whole world is not a closed system. In other words, they also had certain things like they had so many decades of so high productivity that much like a retiree, the whole country had a big stored up nest egg, and they still do. They have over $1 trillion in foreign exchange reserves and things like that. So they even though they have a lot of public debt, they actually also have a lot of assets. They own financial things around the world that provide them interest and dividends to kind of support their expenses. They also have a huge amount of social capital in the sense that they have a very harmonious society that is oddly resistant to kind of political polarization and deterioration. It's not immune, but it's just very resistant to it. And that's a type of capital because, if you don't have people breaking things, you don't have people, you have everybody kind of doing their role in a sense. It limits how much you have to expend on just keeping the wheels going. Now, when the whole world gets to Japan's level, which is kind of in the cards over the next decade or so, there's no like other entity that is going to support us. Like the whole world is kind of Japanifying, except in many cases they're doing it without the giant nest egg that Japan has, and they're doing it without another giant labor pool anywhere to kind of be part of the next stage of the pyramid. And so, on average, I think be a lot more inflationary for the world as we go through that.
A lot more inflationary, well understood. And I guess now that the inflationary, genie is almost out of the bottle, it's definitely entered into the public zeitgeist. It's no longer just money printing. We're expecting prices to rise. It's almost a self-fulfilling prophecy at that point, isn't it?
Well, to some extent, I think that's I mean, price inflation is very closely aligned with money supply growth, with somewhat of a lag. It's not like on a year-to-year basis, but if any sort of like 5-year rolling period, usually money supply growth and price inflation are heavily correlated. Um, and so when you don't have rapid money supply growth, psychology doesn't really do a lot to boost prices. You can get little shortages in certain areas, people hoard things and things like that, but it's not really structural. I think it's more like you get money supply growth without enough productivity to offset it, and then people start to realize it. And so, they start to try to demand the wage increases to keep up with inflation rather than kind of get left behind. So, psychology can contribute to it. But I think politicians often use that as a cop out. I think it ultimately at the end of the day comes down to, are you growing money supply a lot faster than productivity growth? And if so, you're going to get inflation that's going to over time kind of trickle through the economy. And again, inflation's not really one number. There are certain things you can get wildly better at making. Over the past 25 years, you've gotten wildly more productive at making plastic toys, electronics, textiles, things like that. We've automated and offshored those things. We're not way better at making gold and waterfront property and even normal property, beef, kind of grass-fed beef or hospital services. These things have pretty substantial cost to them. And so they tend to reflect the money supply growth a lot more than some of those mass producible goods and services. Now, again, I think in the next several years, some of the things that we're able to mass produce will be a little bit different than it has been in the past 15 years. I mean, maybe we can mass produce accounting services because AI can, let the one accountant do the work of 10 accountants, for example, or 5 accountants, whatever the case may be. Some of these more repetitive white collar services can be made more productive, not by necessarily eliminating those workers, but by making each remaining worker basically a manager, able to kind of use tools, in this case AI tools, to do more than they otherwise would have, which is a form of productivity growth, kind of like how if you give a farmer a tractor, he can do the work of 10 farmers by hand, or more. And I think you can get that kind of mass production of certain services over time. Mass production of art, mass production, or at least of mid-quality art, mass production eventually of video, which is slowly kind of gaining quality. These things and editing services and translation services, certain things can get more productive, but that doesn't really get meat on the table, and things like that.
Well understood. Lyn, what are some historical parallels that you are able to draw upon to try to look out, how this fiscal dominance endgame might look like?
Well, by examining prior long-term debt cycles. So I've pointed out for a while that, again, like this period looks more like the 1940s to the 1970s because of the source of the money creation, and how it's ultimately addressed. And so basically it's coming from the fiscal side, not from the bank lending side. And so I think that's kind of the closest parallel. That's what I've used for investing. Now, things aren't always the same. Again, in the 1940s, the U.S. obviously there was a war, first of all, and also the U.S. had very strong demographics. We had a trade surplus. In many ways, now the U.S. looks like the U.K. did in the 40s, which is we're the incumbent power, the incumbent reserve currency with a trade deficit. In some cases, China is now the U.S. because they're the ones with the really big industrial base. They're the one with the really big trade surplus, with the difference being that they're entering it already old. They already have age demographics, which is a very different situation than the U.S. had in the 40s. So you never have kind of an apples to apples comparison. You can't just say it happened like this, it's going to happen again. Obviously, also technology is way different. Back then, when they inflate away the debt, information moved very slow. Information was very centralized. Now you have social media. Now people can meme about the debasement in real time as it happens. Um, and so it's hard to kind of keep the social wheels on the cart in this environment. So there are a lot of differences too. But basically, the things you can look at are one, what happens in an emerging market recession, because a developed market in fiscal dominance has certain emerging market characteristics. It's not exactly the same, but there's certain directional similarities that you can learn from. And then two, you can look at developed countries in the last time they were in fiscal dominance, which was the 40s and 50s, and see how what assets did good, what assets did bad, what were the social ramifications, and then you can kind of map that all out and think, okay, well, what's different now? How does technology and today's culture change how some of that's likely to play out?
So what was the answer to that question, Lynn? What assets did well in the 1940s, and what do you learn from that for portfolio allocation today?
Well, so harder assets over softer assets. So basically, if you bought equities, if you bought real estate, if you bought, certain commodities, commodity producers, those things did well. Gold was tougher because it was pegged to currencies, and in the United States, I mean, it was legally illegal to own gold, which is crazy. Um, and so you have to kind of adjust things to the current era. But yeah, the short answer is you avoid currency and bonds other than your kind of the amount you need to function, and for like volatility reduction or trading potentially. But you stay structurally long those scarcer things. And then the only caveat is you avoid bubbles where possible. So if something gets radically overvalued, it can still underperform bonds, because if you pay 50 times earnings for a stock that's not growing very quickly, nothing stops it from falling to 25 times earnings, for example, in a more kind of after the bubble kind of rolls over. So you still want to be careful about valuations, but in general, you want to own scarcer things. Um, and uh, and then to some degree, diversification helps because an investor can have a really strong thesis, and then the government can say, well, okay, we're banning that thing. So like, investors like, well, I'm going to buy gold. And they're like, okay, cool story. We're going to make that illegal to do. So we're going to hurt the liquidity in the market and push that all in the gray market, the black market. Um, and same thing can happen today with certain industries. They like nations can nationalize things. They can try to restrict things. So they can you have to expect curveballs to assets that you think are going to do well, and that's generally why you want a handful of bets, um, and to kind of adjust accordingly.
Expect curveballs.
Yeah.
Incredibly interesting. What do you think of this concept of a debasement trade? That kind of implies getting out at some point again for fiat. You mentioned earlier being structurally long hard assets. That kind of implies staying the course and staying within these hard assets.
Well, yeah. So the debasement trade is a term that became popular just recently. It's funny because many of us have been talking about it for quite a while. Um, I mean, basically, it's like you have. I think what's new is that large institutions are talking about debasement and talking about the risks of sovereign debt, which would have been unthinkable a decade ago, pretty much. Um, and so it's kind of the mainstreaming of concerns that many investors have had for quite a while. And in some cases they're late to the party. I mean, basically, when people were talking about that when Bitcoin was worth a tenth of what it is now, and gold was worth a third of what it is now, and stocks were half of what they are now, and bonds were worth 50% more than they are now. Um, a lot of the money was already made in the past 5, 6, 7, 8 years of just being on the right side of all this debasement. If anything, I think some of it could slow down in the sense that, because of how high stocks are priced, I'm less confident that they're going to outperform bonds over the next 3 to 5 years. If you like, in 2019, I was like, sure, stocks are a little expensive, but I'd much rather own them than bonds. Um, and they absolutely killed bonds in that period. Now going forward, I view it. I still lean toward equities over bonds, but I'm a lot more picky on what equities because if you have like I used Costco as an example. They were trading at 55 times earnings earlier this year. Now they're in the upper 40s. Nothing really stops that from potentially going down to 30 times earnings. And so even if bonds get debased, you can still have very high flying equities just kind of roll over and sag. You take on that risk at least. So I think you want to be picky about valuations, and that it's less clear that you just buy a stock index over a bond index. But I still, in general, you still want to be structurally long things that are scarce, meaning that they're resistant to being eroded by AI. They're resistant to just printing more and more of that good. So if you own currency, it's like a good that can just be printed. If you own bonds, they're just printed. But if you own gold, you want to avoid buying into a bubble spike, and kind of make sure your timelines and volatility is in check. But you don't have to worry about money printing per se. And the same thing is true for other kind of assets that have an economic moat, a network effect, something that kind of keeps them scarce, pretty durably scarce, while also being not a very crowded trade. So assets that are on average under-owned or average owned, and that are going to be in demand for 5, 10, 15 years in the future.
We oftentimes hear arguments regarding the commodity complex as a whole that it's been underinvested in for the last few decades. If you look at, for example, copper discoveries, large copper discoveries, there haven't really been any the last few years. Is this a place to be looking for assets that are under-owned like you described?
I think so. I mean, I think you want to be careful because I mean, I've heard the story 5 years ago too, and then so it's like it still wouldn't really play out in a strong sense. Um, I do think again, we don't really have like major shortages right now of most things. Obviously, rare earths have become a lot more politically charged, not because there's not enough of them, but because the borders suddenly matter. Um, Energy is on the cheaper side because at the current time there's still plenty of it relative to demand. But I do think that when you look out several years, I think U.S. shale is kind of gradually rolling over because it's got a high depletion rate and not a lot of reason to invest at these prices. As you mentioned, copper mines. I mean, they take a very long time to bring online. And there's fewer discoveries and kind of less willingness to all the permitting and all the setting up of a very large mine over the long term. So I think when you can find these things at good prices, they're attractive. So I like energy infrastructure. I do like energy and like oil and gas producers, especially the larger ones that are able to kind of weather these longer bear markets and have good balance sheets and can get through things. But that's certainly one of the key slices of my portfolio is to own the commodity complex. For some of the commodities, I prefer to own the underlying. So I've owned gold and uranium more so than gold and uranium producers, for example. But on the other hand, I've generally owned energy producers rather than energy futures, for example, and that's been the better play to be in the producers. So it depends on the asset, but there are pockets of attractiveness there. Yeah.
All right, well understood. And we were talking about a wider index of stocks, for example, SP 500 earlier. Howard Marks, of course, well-renowned investor, recently made a interesting argument, I think, where he argued that the companies that are constituents of the SP 500 are higher quality than ever, and they're also growing faster than ever. So while valuations are definitely historically, elevated, one might argue that these companies also warrant a higher valuation. And he says they're probably still overvalued, but perhaps less so than you would initially think. What do you think of that?
I mean, I think there's reason to that. I mean, I've been long U.S. equities for quite a while, and they've done well. And so you have to kind of look at an individual by individual basis. I do think some of that is changing in the sense that, especially the big tech stocks, they've had very kind of like growth without a lot of capital intensivity because they had big network effects, right? So entities like Google, Facebook, and these others, they've had these really big network effects, Microsoft, where they don't require a lot of capex. They've got a lot of trapped users, basically. And so they would just kind of grow with these network effects, high ROI, and just be able to, kind of grow their balance sheets and the whole time and buy back a ton of shares. Now they're entering a more capital intensive environment where they're fighting over GPUs, and now they're actually doing a lot of hardware investments to try to retain a lot of their customers and stay competitive. So that can actually start eating into their margins and eating into their quality metrics. They kind of are like kind of almost like re-entering the real world here, where there's like hardware spending. Um, and so I still think you want to be careful about valuations. But yeah, when I look at either value stocks or growth stocks, U.S. stocks, foreign stocks, I always take quality into account when assessing them. There's some things that are lower quality I want to pay 8 times earnings for, and there are other things that I am willing to pay 30 times earnings for because they're growing at 20% a year. They have a wide economic moat. They have very high ROI. Um, in general, I think that U.S. kind of tech companies are very high quality, but many of them are also very, very expensive. So I think you want to kind of invest cautiously.
What are you seeing on the international equity front, for example, Asia or Europe? Are you able to find interesting value propositions over there?
To some extent, I've been bullish on Japan and Latin America, and that trade has worked out very well in recent years. I continue to be kind of bullish on those regions. Certain parts of Southeast Asia are attractive. India lagged in 2025, and I think that over the next 2 years, I think they're pretty well positioned. Some of the valuation pressure went down. That's an example of, people say so the thing about India, of course, they have really good demographics. A lot of things are going to be high quality, but you can still overpay for high quality and growth. So I think they're kind of after a little bit of a kind of weaker market. They're entering potentially a better 2 years. China is very cheap, but you have to price, the risk of, getting zeroed out at some point because of geopolitical concerns. And they have, yeah, in general, slower growth, but it's a cheap market. Um, and so I think there are pockets around the world. I've invested in kind of various foreign banks, for example, that have done quite well. So there are pockets. In general, I think that, Chinese currency right now is very undervalued. And if there is some sort of revaluation at some point, those could do very well in dollar terms. But with all these types of plays, you have to kind of price it accordingly because unlike gold in your possession or unlike Bitcoin that you have the private keys to, you could wake up one morning and just like your ownership of these assets is just not yours anymore. That happened to a lot of investors in Russian assets a handful of years ago, where they owned a bunch of undervalued things, including some that were quite well managed and but because of things just outside of the control, it's like, well, that thing in your brokerage account's not really fully yours anymore. And so there are kind of pockets to be careful of. But I think going back to my prior statement that you want to be diversified because governments can throw curveballs at you in a geopolitically challenging or fiscally dominant environment. So you want to find things that are cheap and doing well, but spread your bets out a little bit.
Spread your bets out. Well understood. Beginning of this year, the yen carry trade was an incredibly important thing. It was a wave in the mainstream media that we heard a lot about. Do you believe there's potential to get a second episode of that yen carry trade unwind?
I mean, I think so far that's got a lot more noise than the outcome. I mean, U.S. stocks are high and Japanese stocks are high, and so that got a lot of noise, and it had these little moments. In general, I think that I'm less bullish on the Japanese stock market than I was before, just because it's done so well. So it's not quite as cheap as it was before. They have rising bond yields, and I think at some point the lever that they can still pull is that they can print money, buy back their own bonds, but then also sell some of their reserves to buy back their own currency, so they can stop too much currency weakness. And that would, if they do that, that would impact U.S. bond markets because that's primarily the assets they'd be selling, and that could force the Fed to step in with some liquidity moves. So I think much like the UK gilt crisis in 2022, I think there will be episodes where all this matters. Um, I don't think it's like one big thing you base your portfolio around, unless you're an active trader, perhaps. But I think that there will be little hiccups along the way, and I think the ones I'm watching for 2026 are basically what's going to happen to the Fed balance sheet. because we're ending quantitative tightening, and we're probably going to be shifting to gradual balance sheet increases, and I think the timing and magnitude is still an open question. And then likewise, what's going to happen with Japan when they want to keep running these pretty big fiscal deficits? They also, much like the U.S., they have some tension between their government and their central bank. They've got rising bond yields, and there could be pretty decisive moves. And going back to the debasement thing, the way this always plays out is that investors are not going to get yields that fully compensate them for the amount of money creation that's happening. And that could be outright yield curve control. That could be softer forms of yield curve control, basically central bank support for these bond markets. It could be financial repression, where they kind of force certain pools of capital to own bonds and take the hit on purchasing power. There's lots of different levers that I think are going to play out in the U.S. and Japan in the years ahead, and there will be little mini crises. It's just that things that make headlines are often not what make money. Much like over the past year, people talk about the yen carry trade, and I think things are structurally changing. We've had this kind of 40-year period of you borrow currency, you're basically shorting that currency because the yields just keep going down, and you buy equities, you buy other currencies and things like that. And I do think that we are entering a period where that's going to be less attractive to do, and therefore that can put some downward pressure on these assets. But I don't think it's like a one-time event that's going to play out. I think it'll be punctuated by many little mini crises over the next 1, 3, 5, 10 years.
Well understood, Lynn. Thank you for breaking that down. I would love to take you back to gold and the debasement trade for just a second. One potential outcome that we hear quite often in this sphere of the internet is a potential remonetization of gold. Incentives for governments would be there because it would clean up their balance sheets almost overnight. However, one of the consequences could be inflation. Do you think a partial revaluation, partial remonetization, either in the West or through, for example, a BRICS, trading currency that they're floating the idea around of, is within the cards anytime soon?
Well, I don't think that politicians want to constrain themselves. So I think that that's not something they're going to turn to anytime soon. I do think that it is in a lot of their interest now for the price of gold to go up. For a while, it was in their interest for price of gold not to go up. But now, as gold goes up, it kind of strengthens some of their sovereign balance sheets. They're basically short their own currency and they're long gold. Um, and we've already seen a pretty big move there. And I think that move still has legs to it. Um, I think you'd have to hit a bigger crises before politicians are kind of forced to do something like that. Basically, if their currency's failing and interest rate hikes are not really addressing it because they just blow out the deficit even more, and they need a mechanism to reestablish faith in their currency. There are ways to kind of bring back gold in the system and kind of do a quicker one-time devaluation and then kind of back it up with more gold backing to kind of reestablish a baseline. It's hard to do that until you also fix the entitlement systems. If you're, it's like you can get a blood transfusion, but if you're still bleeding rapidly, that's not going to last very long. It's not like a solution. It's only like a temporary fix. So I think it's going to have to be paired with something like that. But I don't think we're anywhere close to that yet. I think that the crisis has longer to go before moves like that are considered. So part of why I like to be long, just unlevered gold and other scarce assets, is because I'd rather be on the right side of that when that one day comes, even though I don't really plan for it in advance, because anyone who tries to plan for that in advance always kind of expects it around the corner, and then 5 or 10 years go by and they're still expecting it. And so I'd rather be surprised to the upside with something like that versus expect it.
Surprise of the upside. All right. Lynn, what are some of the most obvious or, most investable trends that you foresee for 2026, perhaps 2027, 2028?
Um, I think right now, I mean, the unpopular view in the market, I think regional banks are actually pretty cheap in the U.S. and no one really wants to own them, but they're cheap, and I think that they are probably going to surprise the upside over the next couple of years in terms of performance. I think that Bitcoin is cheap right now. I think it's probably got a good 2 year performance ahead of it. Um, I think that energy is cheap. Energy infrastructure, energy producers, I think those are cheap. Um, I think certain Latin American, Indian assets are inexpensive and are pretty well positioned. And I think, looking back 2 years from now, I think, some subset of that will probably have disappointed, and another big subset will have probably done well. Which again is why I want to spread my bets out so that, I can take a hit on an asset that has been a little bit disappointing. For example, the past 2 years, energy producers and service companies have been kind of disappointing after a really good run in 2022. Um, but generally thinking, there are these pockets that are still attractively priced, and that I don't think are going to be hit by major crises in the next kind of investable time horizon.
Definitely a honeypot of insights there and a great place to start doing some research. Hey, perhaps you can talk about Lyn Alden Investment Strategy for a second.
Sure. So I run lynalden.com. I have public free newsletters and occasionally public articles. And I also have a low-cost research service that goes over macro conditions, investment ideas, and model portfolios and things like that.
And perhaps you can also quickly talk about your book, Lyn.
Sure. So I wrote Broken Money. It came out in 2023, and it covers kind of the history and the future of money through the lens of technology. So how changing technology has impacted money in the past. Kind of explores a pretty deep nature of what money is, how it changes, and people have liked it, from retail investors all the way up to some central bankers have read it. And so people can check it out.
Lyn Alden, thank you so much for your generosity with your time and insights today. Really appreciate it.
Thank you.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.